All right, so today we're going to take a deep dive into covered calls.
Yeah.
It's a topic that a lot of our listeners have been asking about.
Right.
It's something that I think can be a really useful tool for investors,
Yeah, it can be.
especially if you're looking to generate some income from stocks that you already own,
Uh,
or maybe even as a way to kind of strategically exit a position if you have a target price in mind.
exactly.
So we're going to break down all the nuts and bolts,
Yeah.
really kind of get into the nitty-gritty of how covered calls work,
Okay.
so that you can decide if it's a strategy that makes sense for you.
Perfect.
So to kick things off, at its most basic level,
Yeah.
what is a covered call?
So a covered call is a strategy that involves owning shares of a stock and at the same time selling a call option on those same shares.
Okay, so it's like a two-pronged approach.
Three-pronged. Yeah, I like that.
You're kind of doing two things at once.
Yeah.
And typically it's a one-to-one relationship.
Right.
So one option contract covers 100 shares of stock.
100 shares of the underlying stock.
Gotcha.
Yeah.
And it's a strategy that's generally considered to be suitable for investors who have kind of a bullish to neutral outlook on a stock.
Yeah, I would agree with that.
Like they think it's either going to go up or stay flat.
Right. If you think a stock is going to skyrocket, you probably don't want to sell a covered call.
Exactly.
You're going to limit your gains.
You're leaving money on the table.
Right.
Okay, so let's talk about the reasons why someone might want to use covered calls.
Okay.
What are the main benefits here?
Yeah, so there are three main benefits that we'll talk about today.
Okay.
The first one is income generation.
All right, so you can actually make money from selling those calls.
Right. When you sell the call option, you receive a premium,
Gotcha.
and that is income that you get to keep.
Okay.
The second benefit is potentially selling stock at a target price.
Okay.
When you sell a covered call, you choose a strike price for that option.
Right.
And if the stock price goes above that strike price, your shares will likely be called away.
So it's like a built-in exit strategy.
Exactly. You're essentially agreeing to sell your shares at that price.
Gotcha.
And the third benefit is managing an existing long stock position.
Okay.
There are actually a few ways that covered calls can help you manage your stock holdings. One way is by reducing your cost basis.
Okay.
So the premium that you receive when you sell the call option can lower your effective purchase price for the stock.
Gotcha.
Another way is by reducing your delta exposure.
Delta exposure, that's one of those Greek things, right?
Yes, exactly. Delta is one of the option Greeks, and we'll get into that a little bit later.
Okay.
But essentially, delta measures the sensitivity of an options price to changes in the underlying stock's price.
Gotcha.
And when you sell a covered call, you're reducing the overall delta of your position,
Okay.
which means that your portfolio won't fluctuate as much if the stock price moves.
Interesting.
Yeah.
So it's a way to kind of dampen some of the volatility.
Exactly.
And then the third way that covered calls can help you manage your stock holdings is by generating returns in a sideways market.
Right. If the stock price doesn't move much,
Yeah.
you still get to keep that premium that you received from selling the call.
Gotcha. So even if the stock's not doing anything, you're still making some money.
Exactly.
All right, so we've covered the basics of what covered calls are and why you might want to use them.
Yeah.
Now let's dig a little deeper into how they actually work.
Yeah.
So walk me through the mechanics here.
Okay, so as we said before, a covered call involves owning shares of a stock
Right.
and selling a call option on those shares.
Uh-huh.
Typically, one option contract covers 100 shares.
Right. That one-to-one ratio.
Uh-huh.
Okay.
Now, when you sell a covered call, you're essentially agreeing to sell your shares
Okay.
at a specific price, which is called the strike price.
Right.
If the stock price goes above the strike price by the time the option expires,
Yeah.
the buyer of that option has the right to buy your shares from you at that strike price.
Gotcha. So it's like you're setting a price target.
Exactly.
And if the stock hits that target, you're obligated to sell.
Right.
Okay.
But in exchange for that obligation, you receive a premium from the option buyer.
Okay, that premium, that's the income generation part.
Exactly.
Okay.
And that premium is yours to keep, regardless of whether the option is exercised or not.
Gotcha. So even if the stock goes down and the option expires worthless, you still keep that premium.
Exactly.
Okay, I like that.
Yeah.
All right, so let's talk about profit and loss potential here.
Okay.
What's the maximum gain that you can make with a covered call?
So your maximum gain with a covered call is limited.
Okay.
It's the difference between the strike price and the price that you paid for the stock,
Okay.
plus the premium that you received.
Gotcha.
So let's say, for example, you bought 100 shares of a stock at $98 a share,
Right.
and you sell a call option with a strike price of $100,
Mm-hmm.
and you receive a premium of $3.50 per share. for that option. So your total premium would be $350.
Right.
Now, if the stock price goes above $100, by the time the option expires, your shares will likely be called away.
Right. You'll be obligated to sell at 100.
Exactly.
Okay.
So you would make a profit of $2 per share from the difference between your purchase price of 98 and the strike price of 100. And you would also get to keep the $3.50 premium.
Okay.
So your total profit would be $5.50 per share.
All right. So that's the most you can make.
Right.
$5.50 per share.
Correct.
Okay.
No matter how high the stock goes.
Right. Even if it goes to $1,000.
Exactly. You're still capped at that $5.50.
Okay. That's an important point to remember.
Yeah, it is.
Now, what about the maximum loss?
Okay, so your maximum loss with a covered call occurs if the stock price goes all the way down to zero.
Right. The worst case scenario.
Right. In that case, your shares would be worthless.
Right.
But you would still get to keep the premium that you received. So in our example, your maximum loss would be $94.50 per share.
All right. So you're basically subtracting that premium from your original purchase price.
Exactly.
Okay.
So the premium acts as a little bit of a cushion.
It kind of offsets some of that potential downside.
Right.
Okay. And is there a point where we break even at expiration?
Yes, there is, and that's called the break-even point.
Okay.
And it's the price at which you would neither make nor lose money on the trade.
Gotcha.
And you calculate it by subtracting the premium that you received from your original stock purchase price.
Okay. So in our example, that would be $94.50.
Exactly.
All right. So as long as the stock price is above $94.50 at expiration, we're in the green.
Right, you make a profit.
Okay.
But if it's below $94.50, you'll lose money.
Gotcha.
Yeah.
All right. The material that we have for this deep dive also includes a visual representation of this.
Right.
Can you describe what that looks like?
Yeah, so imagine a graph where the horizontal axis represents the stock price at expiration,
Okay.
and the vertical axis represents your profit or loss.
Mm-hmm.
So if you were to plot the profit and loss potential of a covered call on this graph, it would create a kind of a hockey stick.
A hockey stick shape.
Yeah.
I like that.
The left side of the graph would slope upward from left to right,
Okay.
representing your increasing profit as the stock price goes up.
Uh-huh.
And then once the stock price reaches the strike price, the line would flatten out.
So it's like a flat top.
Exactly.
Okay. Interesting.
And that flat top represents your maximum gain.
Gotcha. So no matter how high the stock goes above that strike price, your profit is capped.
Exactly.
Okay, that visual really helps.
Yeah.
All right, so we've talked about the mechanics of covered calls. We've talked about the profit and loss potential.
Yeah.
Now let's dig a little deeper into those three main benefits that we mentioned earlier.
Okay. Cool.
So the first one was generating income through the premium. So can you expand on that a little bit?
Yeah. So this is probably the most straightforward benefit of covered calls.
Okay.
You essentially get paid to sell someone else the right to buy your shares.
Gotcha.
So if you own a stock that you think is going to stay relatively flat in the near term,
Uh-huh.
selling a covered call can be a great way to generate some extra income.
Okay.
Because you're basically getting paid for your expectation that the stock won't move too much.
Gotcha.
And that premium that you receive can really add up over time.
Especially if you're doing this on a regular basis.
Exactly.
All right. The second benefit was selling stock at a target price.
Right.
So how can covered calls be used as an exit strategy?
So let's say you own a stock that you're thinking about selling,
Okay.
but you have a specific price in mind that you want to sell it at.
Right.
You could sell a covered call with a strike price that's equal to your target price.
Huh.
And if the stock price goes above that strike price, by the time the option expires,
Yeah.
your shares will be called away.
And you'll get that target price.
Exactly. And you'll also get to keep the premium that you receive.
Gotcha. So it's like you're getting paid to wait for your target price.
Right. Exactly.
I like that.
Yeah.
And then the third benefit was managing an existing long stock position.
Right.
So let's break that down a little bit.
Okay.
The first point there was reducing your cost basis or break even.
Right.
So how does that work?
So remember, when you sell a covered call, you receive a premium.
Yes.
That premium can be used to reduce your effective purchase price for the stock.
Okay.
So let's go back to our example.
All right.
You bought 100 shares of stock at $98 a share,
Mm-hmm.
and you sell a call option for $3.50 per share.
Right.
So your effective cost basis is now reduced to $94.50 per share.
Okay, so that premium basically lowers the price at which you break even.
Exactly.
Okay.
And it also gives you a little bit more downside protection
Gotcha.
because the stock price has to fall further
Mm,
before you start losing money.
right, because you've already got that premium in your pocket.
Exactly.
Okay. The second point was reducing your delta exposure.
Right.
I know we touched on this a little bit earlier,
Yeah.
but can you explain in more detail how selling a covered call reduces your delta?
Yeah, so remember that delta measures the sensitivity of an options price to changes in the underlying stock's price.
Hmm.
When you buy a call option, the delta is positive,
Okay,
which means that the options price will go up when the stock price goes up.
right.
But when you sell a call option, the delta is negative,
Okay,
which means that the options price will go down when the stock price goes up.
interesting.
Yeah, so when you sell a covered call, you're essentially reducing the overall delta of your position,
Okay,
which means that your portfolio won't be as sensitive to movements in the stock price.
gotcha. So it's a way to kind of smooth out those ups and downs.
Exactly.
Okay. And then the third point was generating returns in a sideways market.
Right.
So if the stock price doesn't really move much, how can you still make money with a covered call?
So you still get to keep that premium that you received from selling the call option,
Right.
even if the stock price doesn't move at all.
Gotcha. So it's like a way to generate income from a stock that's just kind of sitting there.
Exactly.
All right. So we've covered the benefits of covered calls.
Yeah.
Now let's talk about the risks.
Okay.
Because every investment strategy comes with risks.
Of course.
So what are some of the key risks that investors should be aware of with covered calls?
So the first and most obvious risk is that the underlying stock price could decline.
Right.
If the stock price goes down, you'll lose money on your shares.
Mm-hmm.
And the premium that you received from selling the call option will only partially offset those losses.
Okay, so the premium acts as a little bit of a buffer,
Right.
but it's not a complete hedge.
Exactly.
Okay. The material also mentions an increase in realized volatility as a potential risk.
Yes. So realized volatility refers to the actual price fluctuations that a stock has experienced in the past. And if realized volatility increases, it means that the stock price is moving around more,
Right.
which could increase the likelihood that your call option will be exercised.
Okay, so that could force you to sell your shares sooner than you might have wanted.
Right. And you might miss out on some potential upside.
Right. Okay. What about implied volatility?
So implied volatility is a little bit different.
Okay.
It's the market's expectation of how much a stock's price will fluctuate in the future.
Okay, so it's like a forward-looking measure.
Exactly.
Okay.
And if implied volatility increases, it can actually increase the price of call options.
Interesting.
Yeah.
So how does that affect covered call writers?
So if you sell a covered call and then implied volatility goes up,
Uh-huh.
it might become more expensive to buy back that option
Okay.
if you decide that you want to close out your position early.
Gotcha. So it could eat into your profits.
Exactly.
All right. Another risk that's mentioned is the possibility of early assignment.
Right.
So can you explain what that means?
So most options are exercised at expiration.
Okay.
But there are some situations where the buyer of an option might choose to exercise it early.
Okay.
And one of the most common reasons for early assignment is dividends.
Dividends.
Yeah.
Okay.
So if a stock is about to pay a dividend
Uh-huh.
and the call option is in the money,
Okay.
the option holder might exercise the option early
Okay.
in order to collect that dividend.
So that would force the covered call writer to sell their shares,
Exactly.
even if they weren't planning on selling.
Right.
Gotcha.
And that could have some tax implications as well.
Right, because you're realizing a gain or a loss on those shares.
Exactly.
Okay, so early assignment is definitely something to be aware of.
Yeah, definitely.
All right, so we've talked about the risks of covered calls.
Yeah.
Now let's move on to one of the most important decisions that covered call writers have to make,
Okay.
and that is choosing the right strike price.
Yes, that's a big one.
So how do you go about choosing the right strike price?
So there are a few things to consider.
Okay.
The first thing is your outlook on the underlying stock.
All right, so how bullish are you?
Exactly.
Okay.
If you're very bullish on the stock,
Yeah.
you might want to choose a higher strike price
Okay.
because that will give you more upside potential.
Right, but you'll receive a smaller premium.
Correct.
Okay.
If you're more neutral on the stock,
Uh-huh.
you might want to choose a strike price that's closer to the current stock price.
Okay, so like an at-the-money call.
Exactly.
Okay.
And if you're bearish on the stock,
Yeah.
you might want to choose a lower strike price.
Okay, so an in-the-money call.
Right.
Right.
Gotcha. And that will give you the most downside protection.
Right, because you're collecting a larger premium.
Exactly.
Okay. The material also mentions evaluating your exposure to the underlying security
Right.
based on whether you choose an in-the-money, at-the-money, or out-of-the-money call.
Exactly.
So can you walk us through that a little bit?
Yeah, so let's say the current stock price is $97.72.
Okay.
If you sell an in-the-money call with a strike price of $92.50,
Uh-huh.
your net delta exposure will be lower,
Okay.
which means that your position will be less sensitive to movements in the stock price.
Gotcha.
It'll behave more like you own a smaller number of shares.
Interesting. Okay. What about an at-the-money call?
So if you sell an at-the-money call with a strike price of $97.50,
Yeah.
your net delta exposure will be somewhere in between the in-the-money and out-of-the-money calls.
Okay.
So your position will be moderately sensitive to movements in the stock price.
Gotcha.
Yeah.
Okay. And then what about an out-of-the-money call?
So if you sell an out-of-the-money call with a strike price of $105,
Uh-huh.
your net delta exposure will be higher,
Okay.
which means that your position will be more sensitive to movements in the stock price.
So it'll behave more like you own the full 100 shares. Okay. So the choice of strike price also affects your potential rate of return.
Right.
And the material provides an example table that looks at the potential returns for different strike prices.
Yeah.
So let's go through that.
Correct.
For an in-the-money call with a strike price of $92.50,
Uh-huh.
the bid price is $6.40.
Okay.
The break-even price is $91.32.
Uh-huh.
The static rate of return is 1.29%.
Okay.
The profit, if assigned, is $1.18 per share.
Mm-hmm.
And the assigned rate of return is also 1.29%.
Right.
Okay. So with an in-the-money call, you're getting a larger premium,
Yeah.
but your potential upside is more limited.
Exactly.
Okay. Now for an at-the-money call with a strike price of $97.50,
Okay.
the bid price is $3.15. The break-even price is $94.57.
Okay.
The static rate of return is 3.1%. The profit, if assigned, is $2.93 per share.
Okay.
And the assigned rate of return is also 3.1%.
Right.
So with an at-the-money call, you're getting a smaller premium,
Yeah.
but your potential upside is a little bit higher.
Right.
Okay. And then finally, for an out-of-the-money call with a strike price of $105,
Yeah, okay.
the bid price is just 70 cents.
Okay.
The break-even price is $97.02.
Uh-huh.
The static rate of return is 0.72%.
Yeah.
The profit, if assigned, is $7.98 per share.
Right.
And the assigned rate of return is 8.23%.
Right. So you can see there
Yeah.
that with an out-of-the-money call, you're getting a much smaller premium.
Right.
But your potential upside is much higher.
Yeah, if the stock really takes off.
Exactly.
Okay. The material also talks about evaluating key resistance levels when choosing a strike price.
Right.
So what are resistance levels and why are they important?
So resistance levels are price points where a stock has historically had difficulty breaking through.
Okay.
So you can think of them as kind of like ceilings.
Ceilings, gotcha.
Yeah.
Okay.
And they're important for covered call writers because they can help you to choose a strike price that's less likely to be reached.
Okay. So you're trying to pick a strike price that's above a resistance level.
Exactly.
Gotcha.
And one way to identify resistance levels is to use technical analysis.
Okay.
You could look at a chart of the stock's price history
Uh-huh.
and look for areas where the price has repeatedly failed to move higher.
Gotcha.
Yeah.
Okay. Another thing that's mentioned is selecting strikes with probability analysis.
Right.
So how can you use probability to help you choose a strike price?
So every option has an implied probability,
Okay.
which is the market's estimate of the likelihood that the option will expire in the money.
Gotcha.
And you can use this implied probability to help you to choose a strike price that aligns with your outlook on the stock. So, for example, if you think that there's a very low probability that the stock price will reach a certain level,
Yeah.
you might want to sell a call option with a strike price at that level
Okay.
because you'll receive a premium for selling that option.
Uh-huh.
But you think that there's a very low chance that you'll actually have to sell your shares.
Gotcha. So it's like getting paid for taking a risk that you think is very unlikely to happen.
Exactly.
Okay. And you can also use delta as a proxy for probability.
Right.
So, for example, if an option has a delta of 50,
Yeah.
that means that there's roughly a 50% chance that it will expire in the money.
Exactly.
Okay.
So you can use Delta to help you to choose a strike price that has a probability of expiring in the money that you're comfortable with.
Gotcha. So if you're very bullish on a stock,
Yeah,
you might choose a strike price that has a high delta
right.
because you're okay with the higher probability of your shares being called away.
Exactly.
Okay. So at the end of the day, it really all comes down to your individual goals and objectives. Right. For the trade, the material kind of breaks it down into those three categories again.
Yeah.
In the money, at the money, and out of the money.
Right.
So for an in the money call,
Yeah.
what's the main goal there?
So an in-the-money call is generally used when you're looking to generate income.
Okay.
And you're not expecting the stock price to move too much.
Right.
It's a more conservative approach,
Gotcha.
and it has a higher probability of being assigned.
Okay. So you're more likely to have to sell your shares.
Right.
Okay. What about an at the money call?
So an at-the-money call is kind of like the middle ground.
Okay.
It's a good balance between risk and reward.
Mm-hmm.
It has a moderate probability of being assigned,
Okay.
and it can generate a decent amount of income.
Gotcha.
Yeah.
Okay. And then finally, what about an out of the money call?
So an out-of-the-money call is the most aggressive approach.
Okay.
It's used when you're bullish on the stock,
Uh-huh.
and you're looking for the most upside potential. It has a lower probability of being assigned,
Okay.
but it also generates the least amount of income.
Gotcha. So it's kind of like a high risk, high reward scenario.
Exactly.
All right. So we've covered a lot of ground here with strike price.
Yeah, we have.
Let's move on to another important decision that covered call writers have to make,
Okay.
and that is choosing the right expiration date.
Right.
So how do you go about choosing the right expiration date?
So there are a few things to consider here as well.
Okay.
The first thing is time decay.
Time decay.
Yeah.
Okay.
So remember that options lose value over time.
That theta Greek.
Exactly.
Okay.
And the rate at which they lose value accelerates as they get closer to expiration.
Okay.
So shorter-term options experience the most rapid time decay.
Gotcha. So if you're selling covered calls, you generally want to choose shorter-term options.
Right, because you're benefiting from that time decay.
Okay.
But there's a trade-off.
Of course, there's always a trade-off.
Right. Shorter-term options also have less time for the stock price to move in your favor.
Right. So you're giving yourself less time to be right.
Exactly.
Okay.
Yeah.
The material also talks about rolling versus selling.
Right.
So can you explain what that means?
Yeah, so rolling an option means closing out your existing option position.
Okay.
And then opening a new position with a later expiration date.
Gotcha.
And you might choose to roll an option if you want to extend the duration of your trade,
Okay.
or if you want to adjust your strike price.
Right.
And when you roll an option, you'll typically incur transaction costs.
Okay. So there's a cost associated with rolling.
Okay. Now, selling a longer-term option upfront
Yeah.
can be a good strategy if you're not planning on actively managing your position,
Okay.
but you might not be able to generate as much premium income.
Gotcha. So there's a trade-off between potential income and management effort.
Exactly.
Okay. So how does your overall outlook on the stock play into this decision?
So if you have a short-term bullish outlook,
Okay.
you might want to choose a shorter-term expiration.
Right, because you're hoping to capture some of that upside.
Exactly.
Okay.
But if you have a longer-term bullish outlook,
Uh-huh.
you might want to choose a longer-term expiration,
Okay.
because that will give you more time for the stock price to move in your favor.
Gotcha. And what if you have a neutral outlook?
So if you have a neutral outlook,
Yeah.
you might want to choose an expiration date that's somewhere in the middle.
Okay, so like maybe 3 to 6 months out?
Yeah, something like that.
Okay. Let's break down the characteristics of choosing a longer term versus a shorter term expiration.
Okay.
So for a longer term expiration, what are the main characteristics?
So longer-term expirations typically offer more upfront premium.
Okay.
They have less exposure to time decay,
Right.
and they have a lower probability of early assignment.
Okay.
But they also have a higher probability of ending up in the money at expiry.
Right, because they have more time.
Exactly.
Okay.
Hmm.
And what about shorter term expirations?
So shorter-term expirations typically offer less upfront premium.
Okay.
They have more exposure to time decay,
Right.
and they have a higher probability of early assignment.
Okay.
But they also have a lower probability of ending up in the money at expiry.
Gotcha. So it's all about finding that balance between risk and reward.
Exactly.
All right, so we've covered strike price and expiration date.
Yeah.
Now let's talk about managing your covered call strategy.
Okay.
So once you've sold a covered call,
Yeah.
what are some of the things that you can do to manage